Did you know that, according to a study by Dalbar, the average investor underperforms the market by about 4% annually due to emotional decisions like panic selling during market crashes or buying into hype? So, why do so many people make these mistakes, and how can you avoid them? In this video, we'll dive into key strategies from Howard Marks' book, Mastering the Cycle. You'll learn how to understand market cycles, use your emotions to your advantage, and make decisions based on sound principles, not fear or greed. If you've ever felt lost or anxious about your investments, this video will show you how to stay calm, think strategically, and focus on long-term growth. By the end, you'll not only know the ins and outs of market cycles, but you'll also be able to apply these lessons directly to your own financial journey. Whether you're just getting started or looking to level up your strategy, this video will give you the tools to make smarter, more confident financial decisions. Number 1. Understand market cycles. Markets don't move in a straight line. They follow cycles influenced by economic conditions, investor sentiment, and external events. These cycles consist of upswings, bull markets, and downturns, bear markets. Recognizing where we are in the cycle allows investors to make smarter decisions. Buying when prices are low and others are pessimistic, and being cautious when the market is euphoric and overpriced. One of the most critical lessons from Howard Marks is that the ability to understand and interpret market cycles can separate successful investors from average ones. It's not about predicting the future with absolute accuracy, but recognizing patterns and tendencies. Imagine you're considering buying real estate. During a market boom, prices are high because everyone is optimistic and demand is soaring. On the other hand, during a downturn, properties might be undervalued due to fear and low demand. If you understand the real estate cycle, you might avoid buying at the peak and instead look for opportunities during the downturn when prices are lower. To apply this concept, start paying attention to indicators that reflect market sentiment, such as stock market indexes, interest rates, and media headlines. For example, when everyone is talking about how easy it is to make money and optimism is high, consider being cautious. When there's widespread pessimism and fear, begin researching potential investment opportunities. By staying mindful of market cycles, you can reduce emotional reactions and make more rational, strategic financial decisions. Number 2. The role of human psychology in investing. Human emotions, particularly fear and greed, play a significant role in market behavior. These emotions often lead investors to make irrational decisions, buying during periods of euphoria and selling during times of panic. When markets are booming, greed leads to overconfidence, pushing investors to take on more risk than they should. On the flip side, during market crashes or downturns, fear dominates, causing many to sell off their investments in a hurry, often at a loss. Recognizing the impact of these emotions is key to avoiding poor decisions driven by short-term market fluctuations. A good example of this can be seen during the dot-com bubble of the late 1990s. Many investors jumped on the bandwagon, buying technology stocks with the belief that the market would continue to soar indefinitely. This greed-driven behavior inflated prices far beyond the actual value of the companies. When the bubble eventually burst in the early 2000s, many of those investors panicked and sold off their positions at a loss, driven by fear. In contrast, an investor who understands the role of psychology can stay disciplined. Instead of following the crowd during times of market extremes, they can maintain a long-term perspective, focusing on fundamentals rather than short-term price movements. During a market boom, rather than getting swept up in the frenzy, a disciplined investor would ask themselves whether the asset is truly worth the price or if the market is being overly optimistic. Similarly, during a market crash, instead of selling out of fear, they might view it as an opportunity to buy valuable assets at a discount. For everyday practice, it's important to create a financial strategy that's rooted in your long-term goals rather than responding impulsively to market swings. Set rules for when to buy and sell based on the underlying value of investments, not on market trends or emotions. By staying disciplined and sticking to your plan, you can reduce the impact of fear and greed on your portfolio. Number 3. Risk management over return chasing. Successful investing is not just about maximizing gains, but also about minimizing losses. One of the biggest mistakes investors make is chasing after high returns without fully considering the risks involved. Often, during times of market euphoria, when prices are soaring, many are lured into risky investments in pursuit of quick gains. However, this can lead to significant losses when the market corrects itself. For instance, in the lead-up to the 2008 financial crisis, many investors chased returns in risky, subprime mortgage-backed securities, believing they could continue to generate high returns. However, when the housing market collapsed, these investments turned into massive losses for those who hadn't properly managed their risk. A more cautious approach is to always evaluate the risks you're taking, particularly when markets are at their most optimistic. Before making an investment decision, assess whether the potential reward justifies the risk involved. A good strategy is to look for investments that offer a favorable risk-to-reward ratio, where the risk of loss is manageable and the potential for gain is reasonable. In practice, this means building a diversified portfolio that reduces your exposure to any one risk factor. During periods of market euphoria, resist the temptation to pile into speculative investments simply because they're performing well in the short term. Instead, focus on investments that align with your long-term strategy, ensuring they are well-positioned to weather market downturns. Always ask yourself, what is the risk I'm taking, and is it worth the potential return? Number 4. Contrarian thinking is key. The best investment opportunities are often found when others are overly fearful or overly optimistic. In times of market distress, fear can drive down asset prices to unjustifiably low levels, presenting a buying opportunity for those with the foresight to recognize value. On the flip side, during market booms, irrational exuberance can inflate asset prices beyond their intrinsic value, offering a chance to sell or avoid the market. Take the example of Warren Buffett, one of the most successful investors of all time, who famously said, "Be fearful when others are greedy and greedy when others are fearful." During the 2008 financial crisis, while many investors were selling their holdings in panic, Buffett was buying stocks of financially strong companies at a significant discount. This contrarian approach allowed him to take advantage of the extreme market conditions, ultimately leading to outsized returns as the market recovered. In practice, contrarian thinking means going against the crowd, especially when emotions like fear or greed cloud judgment. When the market is overly optimistic, assess whether prices are inflated beyond sustainable growth, or when panic sets in, analyze whether there is still fundamental value in certain assets. It's about being patient and taking calculated risks when most people are too scared or overly confident to act. By recognizing the extremes of the market cycle, you can position yourself to profit from the natural market corrections that follow. For everyday investors, this can be as simple as doing your own research, sticking to your long-term strategy, and resisting the urge to make impulsive decisions based on the latest market trends or news. Number 5. Focus on long-term value. Short-term trends can often create noise that distracts from the true potential of investments. Stock prices can fluctuate due to market sentiment, news, or macroeconomic factors, but these movements don't always reflect the underlying health of a company. To truly succeed in investing, it's crucial to look beyond the immediate price swings and focus on the long-term value of the assets you hold. For instance, during periods of economic uncertainty, many investors may panic and sell off stocks in fear of losses. However, if you focus on the long-term potential of companies with strong fundamentals, such as a robust business model, solid earnings, and a competitive edge, you can see past temporary downturns. Over time, these companies are likely to weather the storm and deliver growth that reflects their true value. A good example is the tech industry. In the early 2000s, many tech stocks experienced significant volatility. Companies like Apple and Amazon faced major setbacks in their early days, But those who saw the long-term value in their business models and held on to their investments were rewarded with massive growth as these companies solidified their leadership in the industry. To apply this in your daily life, it's essential to make decisions based on a company's long-term prospects rather than getting swayed by short-term market movements. This requires doing thorough research, understanding the fundamentals of the businesses you invest in, and having the discipline to ignore the noise. Focusing on long-term value helps you stay grounded and make more rational investment choices, even when the market is full of short-term distractions. Number 6, the importance of patience and timing. In investing, knowing when to act or when to hold off is often just as important as making the right investment decisions. While market trends can be tempting, jumping in too early or too late can impact your returns. The key is understanding when risks are low and rewards are high, and waiting for those ideal opportunities to arise. For example, during periods of market optimism, everyone may rush into stocks due to fear of missing out on potential gains. However, those who wait and remain patient can often find better entry points when the market corrects or when a stock becomes undervalued. Timing isn't about perfectly predicting the market, but rather about understanding that not every moment is the right one to invest. A practical illustration of this is seen during market corrections. Instead of selling out of fear, a patient investor might see this as an opportunity to buy quality assets at a discount. If you can wait for moments when the market has overreacted to short-term news or sentiment, you can position yourself for greater long-term returns. In everyday life, patience and timing apply to more than just investments. It's about resisting the urge to act impulsively and instead waiting for the right conditions to make a move. Whether you're considering buying a stock, starting a business, or making a significant purchase, understanding when to wait for the ideal moment can make a huge difference in your overall success. Keep an eye on the long-term picture and don't rush decisions just because others are moving quickly. Number 7, prepare for uncertainty. Markets are inherently unpredictable. No matter how much research or analysis you do, you cannot anticipate every event that will impact stock prices, interest rates, or global economies. However, understanding market cycles and the inherent volatility allows you to prepare for uncertainty and mitigate the risks associated with unpredictable events. A good strategy is one that embraces uncertainty by ensuring that your investments are diversified and resilient. For instance, during market downturns or economic recessions, you may find that some sectors or industries remain more stable than others. Having a mix of assets, such as stocks, bonds, and perhaps even alternative investments, helps protect your portfolio when one area suffers due to unexpected events like a global health crisis or geopolitical conflict. In everyday life, preparing for uncertainty is crucial not just in investing, but in all decisions. Whether it's setting aside emergency savings or considering multiple career paths in case one doesn't work out, having a plan that accounts for unpredictable events will make navigating tough situations much easier. Financial preparedness and strategic thinking ensure you are ready to handle market fluctuations without panic or rash decisions. A practical tip would be to create a risk management plan for your investments. Set clear limits on how much you are willing to lose in any one position, and always have an exit strategy or a buffer in place. This helps ensure that even if things don't go as expected, you won't be caught off guard, and you can make calculated decisions in times of volatility. Number 8, economic indicators and their role. Economic indicators are vital tools for understanding the broader health of the economy, and they play a critical role in predicting market cycles. Interest rates, inflation, and credit availability can all impact the behavior of financial markets. For example, when interest rates rise, borrowing becomes more expensive, which can lead to slower economic growth and reduce corporate profits. On the other hand, low interest rates can encourage borrowing and stimulate spending, potentially driving market growth. Inflation is another critical factor. When inflation is high, purchasing power declines, which can hurt both consumers and businesses. If inflation rises too quickly, it may signal that the economy is overheating, which could lead central banks to raise interest rates to cool things down. This chain reaction can cause shifts in the stock market and bond yields. Similarly, credit availability determines how easily businesses and individuals can access capital. If banks tighten lending standards, businesses may struggle to invest in growth, and consumers may cut back on spending, which can result in slower economic growth and weaker market performance. To better position your investments, it's important to keep a watchful eye on these macroeconomic indicators. For instance, if inflation starts to rise, you may want to consider shifting to assets that typically perform well during inflationary periods, such as commodities or real estate. Conversely, if interest rates are expected to drop, bond prices may rise, and certain sectors such as technology may perform better. A practical daily tip would be to stay updated with the latest economic reports. Many financial news websites provide updates on key economic indicators like interest rates, inflation data, and consumer confidence. By paying attention to these trends, you can adjust your investment strategy accordingly, making more informed decisions based on the economic climate rather than reacting to short-term market fluctuations. Number 9. Margin of safety in investing. The margin of safety concept is about ensuring that you're making investments with a buffer for errors. It means investing in assets or companies that are priced below their intrinsic value, which gives you a cushion against unforeseen risks or downturns. This principle is essential because no one can predict the future with certainty. By buying undervalued assets, you minimize the potential for loss, even if unexpected factors impact the market or a specific investment. In practical terms, this means you should avoid investing in companies or assets that are overpriced or hyped up during market booms. For example, during a market rally, prices of stocks might soar beyond their actual worth, often driven by sentiment or speculation. If you invest in these overvalued stocks, there's a higher risk of significant losses when the market corrects itself. A margin of safety helps mitigate these risks by ensuring you're not overexposed to potential market corrections. To apply this principle, always assess the value of a company or asset before investing, and compare its current market price to its intrinsic value. If the market price is significantly higher than its intrinsic value, this should raise a red flag. In practice, this could mean looking at companies with strong financials, a solid track record of earnings, and a competitive advantage, but buying them only when they're trading at a discount compared to their future growth potential. A practical tip for day-to-day investing is to set a threshold for yourself. Only invest in assets where the market price is at least 20 to 30% below what you believe their true value is. This ensures you're not taking excessive risks, especially in overinflated markets, and that you're leaving room for any market volatility or miscalculations that might occur down the line. Number 10. Lessons from historical patterns. History may not repeat itself exactly, but it often follows similar patterns. By studying past market cycles, economic events, and trends, you can gain valuable insights into how markets react during different conditions. Understanding these patterns helps you make more informed decisions about what to expect in the future, even if the specific circumstances are different. For example, during past recessions, markets tend to overcorrect, and stocks of fundamentally strong companies often become undervalued. By recognizing this pattern, you can identify opportunities to buy these stocks at a discount when others are fearful. Conversely, during times of market exuberance, prices can become overinflated, leading to potential bubbles. Knowing how these cycles work can help you avoid getting caught up in the hype and making emotional investment decisions based on short-term trends. A practical way to apply this concept is by studying key economic downturns, booms, and busts from the past, like the dot-com bubble or the 2008 financial crisis. By analyzing how markets reacted during those times, you can begin to recognize warning signs in today's market. For instance, if you notice certain sectors becoming overly popular and seeing rapid price increases without fundamental backing, you may be able to identify a potential risk before it becomes a crisis. To incorporate historical patterns into your strategy, Set aside time to regularly review market history and compare it to current market conditions. This can help you anticipate both risks and opportunities. For example, if there's an economic downturn on the horizon, understanding how markets have rebounded after similar events in the past can help you maintain a long-term perspective and avoid panic selling.